Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about VERRA Mobility Corp. Quarterly Report. VERRA Mobility Corporation offers a range of smart mobility technology solutions across various regions. The company's business segments include commercial services, providing automated toll and violations management, title and registration solutions to rental car companies and fleet owners, government solutions, offering photo enforcement solutions for speed, red light, and school bus stop arm enforcement, as well as traffic enforcement products and maintenance services, parking solutions, providing integrated parking software, transaction processing, and hardware solutions to universities, municipalities, healthcare facilities, and commercial parking operators. The VERRA Mobility Corp. (VRRM) stock price has remained relatively stable over the past year, with no significant changes exceeding 0.39%. While several news announcements were made by the company, including strong third-quarter results and updated fiscal year 2025 earnings guidance, these events typically caused fluctuations above this threshold. The lack of significant change can be attributed to the normal volatility of the stock market, where daily movements often exceed minimal thresholds like 0.39%. The primary drivers of revenue growth or decline can be summarized as follows. Revenue growth is primarily driven by the expansion of service revenue in commercial services and government solutions segments. Key contributors include commercial services increasing by 104%, government solutions growing by 19%, and increased tolling and travel activity, leading to higher volume rebates. Additionally, product sales from photo enforcement equipment and specialized hardware have contributed significantly. On the other hand, revenue decline is mainly attributed to flat revenue in the parking solutions segment due to offsetting effects of SaaS product offerings and professional services, and decreased subscription services related to parking management solutions. Furthermore, lower revenue generated from FMC customers due to customer churn has also impacted commercial services. Net income and profit margins experienced significant changes between 2024 and 2025. Net income rose by 20% to $117,753 in 2025, with an even more substantial increase of 34.9% to $46,839,000 in Q3 2025. This growth can be attributed to the One Big Beautiful Bill Act, OBBBA, which may have positively impacted tax liability and net deferred tax assets. Profit margins also saw improvements, with service revenue margin increasing from 15.4% in 2024 to 17.9% in 2025. The operating expenses margin remained relatively stable at 33.6%, while the net income before taxes margin rose from 21.5% to 24.7%. Additionally, the effective tax rate decreased from 28.4% to 27.6%. The increase in service revenue, which grew by $25,952,000, 11.9%, contributed significantly to the improvement in profit margins. This growth was driven by expansion in commercial services and government solutions. While operating expenses increased at a slower rate than service revenue growth, they still rose by $12,000 and $10,000, 15.8%. Overall, these changes indicate a positive trend for the company's financial performance. The company is indeed generating positive operating cash flow, a significant indicator of financial health. The data reveals that in 2025, the net cash provided by operating activities reached $215,828, marking a substantial increase of $32.6 million from the previous year's figure of $183,155. This upward trend demonstrates the company's ability to generate sufficient cash flow from its core operations, positioning it for future growth and stability. The company's debt level has undergone a slight decrease, with long-term debt decreasing by $4.273 million. However, it is the interest expenses that have seen significant reductions. Interest expense has dropped by 12% from $18.723 in 2024 to $16.421 in 2025, and by 13% from $57.203 in 2024 to $49.629 in 2025. The loss on extinguishment of debt and the loss on interest rate swap have also decreased substantially, indicating a successful refinancing strategy that has led to lower interest expenses for the company. The performance overview: the company's financial performance reveals a mixed bag across its segments. Commercial services and government solutions initially showed strong growth, with the former achieving the highest segment profit at $78,284. However, both segments experienced setbacks due to external factors. Travel demand and extreme weather events impacted commercial services, while reduced political acceptance of automated safety programs affected government solutions. Parking solutions also faced challenges, as increased usage of public transportation or rideshare services led to a decline in its segment profit. Management is optimistic about the company's outlook, citing a focus on organic growth through long-term contracts and a recurring service revenue model. The company expects significant revenue contributions from installing up to 250 red light cameras by year-end 2025 and has been selected as the vendor for New York City's automated enforcement camera safety programs for an expected 5-year period. Management also believes they have sufficient liquidity to meet operating cash requirements and debt obligations for at least the next 12 months. However, there is a risk that the company may not be able to comply with debt covenants if economic conditions worsen or their business performance declines, which could impact their ability to pursue strategic acquisitions. The company's financial summary reveals that it has engaged in a significant share buyback program. Over the past period, the company purchased a total of 7,218,850 shares at an aggregate cost of $200 million. This indicates that instead of distributing profits to shareholders through dividends, the company chose to repurchase its own shares, potentially boosting earnings per share and enhancing shareholder value. Concerns about inventory buildup and supply chain disruption: the company's financial summary highlights a significant increase in inventory levels, from $15.5 million at the end of 2024 to $21.7 million by September 30, 2025. This surge is particularly evident when comparing the 9-month inventory level for both years, which has risen from $511 in 2024 to $3,762 in 2025. These numbers raise concerns about potential inventory buildup and supply chain disruption, indicating a need for careful management of inventory levels to avoid future issues. That concludes the financial summary for VERRA Mobility Corp. Feel free to comment below, and I will be happy to answer them when possible.